Okay, let's get ready for financing. It's a basic video that goes over the basics of business financing. Should give you a good foundation to understand certainly capital structure. So there are two basic methods of financing that we're going to talk about today: debt financing and equity financing. Here are a couple of methods of debt financing. Okay, first, these are the common creditors that provide debt financing. Now, of course, a creditor is someone who provides debt financing by definition. But commercial banks, asset-based lenders, what an asset-based lender is a lender that loans based upon your assets and takes the assets as security for the loan. Finance companies, uh, pension funds, insurance companies, and private equity firms. These last three in particular handle debt financing for large companies. And again, remember, we're talking about corporations in general. We're not specifically talking about small, medium-sized enterprises or startups, because not all of these financing methods are going to be available to startups. Debt financing, as I'm sure you already know, is the act of borrowing funds. And when we talk about capital, we're talking about long-term funds, long-term borrowing. When you borrow from these financial institutions, there are a couple of things that you need to keep in mind. Pledging collateral. Again, collateral is an asset that you have that the lender uh, has a security interest against. So that if you fail to pay the loan, the ownership of that collateral moves over to the borrower, the lender. And simply put, an example: if you pledge your house and you don't pay the loan, okay, the bank gets your house. That's a collateral loan. Collateral loans are oftentimes easier to get than non-collateralized loans because if there's a problem, there is an asset that's backing up the loan. Loan rate. What is the rate at which you're going to pay? Prime rate, and the prime rate is it is an English an English term for American interest rate, which is basically it's the rate at which the best firms borrow at. Now, of course, there are only a few firms that qualify for prime rate, and everybody pays much more. There's fixed rate versus floating rate. Okay. There are different types of business loans, and there are loans backed by government. Again, fixed rate, floating rate. A fixed rate is a rate that is consistent throughout the term of the loan, while a floating rate will vary depending upon market conditions. And there are advantages and disadvantages to both, as you might expect. If you expect interest rates to be going down, then maybe a floating rate might be something that you might be interested in. If you believe that interest rates are going to be going up, then perhaps to lock them in a fixed rate might be preferable to you. Issuing bonds. What is that? Well, basically, large companies, instead of going to a financial institution and borrowing, they can borrow directly from the public. And so they issue a piece of paper called a bond, which is a long-term debt security. And these bonds are purchased by, we'll call them investors, but I don't really like to call them investors. We'll call them bond investors. Because generally when we talk about investors, these are people who purchase equity. But let's, for the moment, take these are bond investors. Now, par value is the amount that bondholders receive at maturity. So you would buy a bond and you get a certain interest rate over the time period of the bond, and then at the end you get this par value at maturity. Maturity is when the term of the bond is finished. An indenture. Indenture is the legal document that explains the obligations to the bondholder. These are details that you probably don't need to know, but it's good to have an idea of these of the definitions because you may hear these terms. Secured bond, again, it's a bond that is backed by collateral. Unsecured bond, bond that's not backed by any sort of collateral. Now, what's from a bond purchaser perspective, collateral is relatively collateralized bond. A secured bond is relatively safe because it's backed by the assets. If they don't pay, you get the assets. From a unsecured perspective, okay, it's not backed by any collateral. But in that sense, the bond purchaser, the people who are actually lending the money, are oftentimes in a stronger position because then they have the ability not just to go after one type of asset, but they have the ability to go after pretty much everything in the company. A call feature. Okay? Generally, if you issue a bond that's 5 years, you need to continue to pay interest for 5 years, and then at the 5th year, the bond matures and the bondholder gets this par value. But what if conditions change and you want to pay back the loan? In some cases, you can just go out in the open market and buy the bond back. Then you own the bond. In other cases, there's this call feature, and a call feature is basically the company that issues the bond has the right to repurchase the bond before maturity, and usually they have to give some sort of incentive or premium to the bondholder because the bondholder has purchased it in good faith that he or she is going to be able to hold it for the period of the bond. Default risk. Default risk, is the risk of non-payment, and it's a risk that affects the interest rate. Companies that are at higher risk to default are going to have to pay a higher interest rate in order to get people to purchase their bonds. And finally, protective covenant is, again, restrictions on what the company can do. If you loaned money to a company, you probably would want. Ooh, let's get out of here. I didn't realize I had Skype up. Let's quit. Let's quit that. Okay, so if you loaned money to a company, okay, you would want to make sure that they wouldn't do anything crazy. So these protective covenants kind of restrict the behavior of the company. Okay, so that's issuing of bonds. Issuing of commercial paper. Now, issuing commercial paper is strictly for the biggest and the best companies in the world. It's basically the company just writing a piece of paper that says, I owe you this money and will pay you a certain rate. And the commercial papers are issued 30 days, 60 days, and 90 days, usually. So instead of having to go to a bank, instead of having to go through a whole lot of rigmarole, you just issue commercial paper. And banks and other financial institutions that are looking for short-term investments buy this debt. Impact on debt levels on interest expense. Of course, the higher level of debt you have, the higher interest you're going to pay. Interest is tax deductible, so in one sense that's good. On the other sense, of course, you don't want to have to you don't want to be in debt because it increases the risk of financial failure. So they're good and bad. But another advantage, of course, of issuing debt is that you can retain the ownership in the company. If you issue equity, you dilute your ownership. And we'll talk about dilution in a little bit. This is especially important for entrepreneurs and small and medium-sized companies because if you issue more stock, the percentage that you own is going to go down, and that's going to have an impact on your wealth, perhaps, and it's going to have an impact on your ability to manage the firm long term. So this is just a quick graphic on different interest rates charged. So the fixed rate, okay, is clearly here in the center. This is a 5-year or so term. A floating rate, okay, when interest rates go up, and a floating rate when interest rates go down. So again, depending upon what you expect interest rates to do, that will have an impact on your decision to go after either a fixed or a floating rate bond or loan. These agencies, Moody's, Standards & Poor's, and there are a couple of others, have a significant impact on the interest rates that companies pay. They have a significant impact on the interest rates that countries pay. Now, the highest AAA and the lowest, depending upon, is D, triple D, or C, depending on if you're Moody's or Standard & Poor's. Now, what's a little bit crazy about this is that Moody's and Standard & Poor's are not government agencies. They're not supra-government agencies. It's not the UN. These are just private companies that investigate other companies and say if they are a good rate or not. So the fact that these have significant impact on the creditworthiness of companies and even countries is a little bit crazy. I mean, just because Standard & Poor's says that your credit risk is this, that doesn't make it true. However, their impact is tremendous. We have a unique financial strategy. Borrow until all the banks cut us off, and then look for a naive investor who's willing to invest equity. The more you know about finance, the more funny that will be. Remedies for debt problems. Okay, if you're running into problem, you can oftentimes negotiate an extension of the loan. Okay. Sometimes you can, if that doesn't work, sometimes you can do a composition. Where composition is where the firm will provide its creditors with a portion of what they're owed instead of the entire amount. There are also times when you can refinance, meaning that you take the debt and you roll it into another loan that covers the individual loans in that package. There are a number of remedies for debt. Of course, just do better in the business, increase profits, reduce expenses, reduce your operating expenses, so you have more profits, so you can pay down the debt faster. So there are a number of different remedies, but it's important that you control your debt, because once the owners of the debt, okay, kind of share control of the company with you to a certain degree. Private liquidation. Okay, it's a situation where the creditors believe that the company cannot continue as a going entity, and they get together and they make the company liquidate, sell all of its assets to pay back the debt. It's more of it's kind of an informal, quote-unquote, bankruptcy. In the formal remedies, you actually have bankruptcy. And in some jurisdictions, there are different types of bankruptcy. Some where it's Chapter 11, for example, in the U.S., where the company is allowed to reorganize. So what it does is it prevents the creditors from attacking and suing the company while the company tries to come up with a plan to satisfy them. And once it comes up with a plan, all the creditors have to agree, and the company can come out of Chapter 11 and move forward. Chapter 7, on the other hand, is liquidation. Okay. A liquidation where, just like in the private liquidation, the company is forced to sell everything to pay back any creditors. And this liquidation value is the amount that is left when you sell everything. That's the liquidation value. And then the residual value is what happens when you sell everything, pay off all your debts, and is there anything left over? And if there is anything left over, that then goes to the common stock owners. Okay, let's take a stop here, and then we'll go into some equity financing options that you might have.